It is Wednesday, August 22nd, 2018. I'm Gord Long. As is normally the case, we have a lot of charts for us to go through, so therefore we'll pass over some of them quickly but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing or you'll not be able to see some of the detail I'll be discussing in the charts. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. The purpose of the audio is to discuss key developments in those areas not specifically updated in this month's macro online updates. The research document this month updates regional economic developments. Therefore, our slides will focus on our other three report areas of our monthly report: global risk, macro, and U.S. economic developments. As I so often do, I like to tie them together into a single discussion on what I see is unfolding in the global markets. We warned of this in 2014 in our series then on the echo boom. We felt then that though the monetary policies of quantitative easing and ZIRP might temporarily be successful in pulling needed demand forward, the real problem would be when the resulting demand hole was reached and the oversupply build-out that resulted from this demand and cheap investment money came home to roost, and specifically in the emerging markets. The emerging markets being the dominant suppliers of commodities for, and in many cases the producers of, the imported goods to satisfy the artificial demand creation. Emerging markets were also the borrowers of excess debt to expand to meet the demand using then cheap U.S. denominated debt, the cardinal sin of foreign borrowing. I would therefore like to cover the items outlined here. Since this involves close to 70 slides, I have been forced to break the discussion into two parts, and this session will be part one. Global banking stocks are plunging, emerging market stocks are cratering, and emerging market currencies continue their stunning decline. The shakiness of global financial markets has many investors wondering what trouble the fall will bring to America, where markets currently appear quite placid, at least on the surface. However, there are clear problems, as this chart isolates in the intersection of tightening central bank monetary policies, the global systemically important banks or GSIBs, and emerging markets. Though the NASDAQ shown here still seems unaffected, these problems will soon wash ashore in America, in our opinion. The Morgan Stanley Emerging Market Index is signaling this is to come. The emerging markets are leading the chart lower, having fallen 20% from their peak. This means that they are officially also now in a bear market. When we examine all the global individual stock exchanges together, we see we are well on our way to a potential global stock market correction, or possibly even worse. Global stocks have now fallen beneath all key moving averages. Those key moving averages are important psychological thresholds for investors, and if we have a few more days, like Wednesday, August the 15th, we could see global financial markets go into full panic mode. When demand for industrial metals falls, this indicates that an economic slowdown is coming. Prices for industrial metals have fallen to their lowest level in almost a year. If the financial carnage continues, this could be the beginnings of another financial crisis like we experienced in 2008, and that would almost certainly mean a crippling global recession. Of course, once the next global recession begins, it is likely to be more painful than we have ever seen before in modern history, because the global debt bubble is far larger than it has ever been before. Global banking stocks are now down a whopping 23% from the peak established earlier this year, and that means that they have officially entered a bear market. European banking stocks have now officially entered a bear market, and all major European stock indexes are now red for the year. The global carnage is increasingly becoming broad-based, with Turkey and Argentina particularly hardest hit. The Shanghai Composite closed at its lowest level since January 2016. German bunds are trading back below 30 basis points. The Malaysian ringgit is the latest Asian currency to experience the effects of slowing growth, sliding to the lowest in 9 months, and the BTP remains at levels the Italian government can't afford as their equity markets continue to noticeably underperform their brethren. Yet U.S. equities are impervious to it all. As Glushkin chef's David Rosenberg notes, and I quote, "No contagion, eh? The only folks that can't see it is in the FX and commodity markets, where they're spending too much of their day gazing at the SPX and Russell 2000. There is no decoupling, just lags. End of quote. The growing contagion wave should be no surprise, and warning signs from both Argentina and now Turkey have been evident for some time. With a strengthening U.S. dollar and slowing global trade, which we outlined in detail in the last Under the Lens video, the globalization cycle, the contagion wave is steadily creating increasing havoc in most emerging markets. There are many emerging market countries not getting the visibility they should, at least not yet. While the market is finally paying attention to the accelerating Turkish collapse and specifically the risk of contagion to Europe, Asia, and ultimately U.S. capital markets, the truth is that this crisis has been a long time in the making. In fact, the first break in the strong emerging market narrative emerged in late April, when as a result of rising U.S. interest rates, the dollar surge began in earnest, facilitated by China's first easing announcement on April 17, which in turn sent both the emerging market currencies and emerging market debt reeling, to be followed shortly by the plunge in the biggest emerging market currency of all of them, the Chinese yuan. Higher U.S. rates finally caused a higher U.S. dollar, courtesy of the People's Bank of China, at which point emerging markets started to crack across the board. But while many had pointed to the collapse in the Turkish lira, the Argentine peso, the Indonesian rupiah, as cracks in the emerging market narrative, the truth is that we have an emerging market debt problem across the board, primarily the result of 1, a strong U.S. dollar, 2, slowing trade, and now 3, worries of a global trade war. I have warned about and posted my concerns regarding emerging markets for some time now. Specifically, many, including myself, have set the critical tipping point in the emerging markets to be the Brazilian lira, if it was to break the magical four handle. In light of the latest emerging market turmoil, the Brazilian real, which plunged as low as 3.9 versus the dollar after the Brazilian finance minister said he saw no need to interfere in the foreign exchange markets, is now on the verge of crossing the key level that has been a virtually guaranteed predictor of accelerated contagion globally. So far, the media focus has been primarily about FX and currency movements, but bond and credit prices are also getting hit, which is driving up 1, current account funding, 2, debt rollover costs, and 3, destabilizing certain regional banks. A secondary fail-safe emerging market stress indicator is, to quote Bank of America's Chief Investment Officer Michael Hartnett, and I quote, "An EMB below 107.5 is contagious." End of quote. This means that once the EMB, the GPM Emerging Market Bond ETF, drops to 107.5, the level it hit right after the Trump election, it will be time to get out of the emerging markets Dodge City. Where is the EMB today? It just dropped to 105.75, the lowest level since February 2016, and validating the negative signal about to be launched. It appears it is time to start worrying. The main media focus today, however, is targeted on Turkey and its potential global contagion effects. This is not at all misplaced, in my opinion. We at MATA SII have seen the potential for a major debt default in Turkey for some time now. The initial phases of Turkey's crisis have so far been a replay of past emerging market currency crises, a mix of domestic and external events, an overstretched credit-led growth strategy, concerns about central bank policy, autonomy, and effectiveness, and a less hospitable global liquidity environment owing in part to rising U.S. interest rates destabilizing the foreign exchange markets. We feel there is better than a 25% chance of a Turkish default within 12 months, primarily because Erdogan is not following the 3 standard responses to a funding crisis. 1, an aggressive monetary and fiscal response. 2, seeking help from outside, such as the European Union or International Monetary Fund. And 3, creating a currency board, closing convertibility to the Turkish lira. The present approach contains some of these elements, which could lead to further escalation and an overall emerging market crisis. The concern to many is that Turkey will be forced to impose capital controls, enforcing a near total loss of U.S. $500 billion of credit assets held by the global financial system. That is a large financial hole in a still highly leveraged system. That scale of loss will surpass the scale of loss suffered by the creditors of Bear Stearns. And while Lehman did have liabilities of US $619 billion, it has paid more than $100 billion to its unsecured creditors alone since it went into bankruptcy. It is the nature of emerging market lending that there is little in the way of liquidity assets to realize. They are predominantly denominated in a currency different from the liability, and also title has to be pursued through the local legal system. Turkey will almost certainly be the largest emerging default of all time. Should it be forced to resort to capital controls, as we suspect, it could also be the largest bankruptcy of all time given the difficulty of its creditors in recovering any assets. So the recent events represent only the end of the beginning for Turkey. The true nature of the scale of its default and the global impacts of that default are very much still to come. What we need to understand, and this is important, is that strong forms of capital controls produce a de facto debt moratorium, and very rapidly investors realize just how little their credit assets are worth. As an example, a debt moratorium at the outbreak of the Great War in 1914 bankrupted almost the entire European banking system. It was saved by mass government intervention. While the imposition of capital controls in recent years has hit select investors hard in Iceland, Cyprus, Greece, and key emerging markets, there has been nothing of this size, and it is to be fully borne by financial institutions who believe they hold not just valuable credit assets, but actually liquid credit assets. The loss of hundreds of billions of assets recently considered liquid by global financial institutions through the de facto debt moratorium of capital controls will be a huge shock to the global financial systems. This is a different type of default, and its nature, as well as its magnitude, will blindside, in our opinion, the financial institutions. So far, the problems in Turkey have been a currency problem. The real issue is that it will soon become a debt crisis. Investors fear that Turkish lenders will struggle to find the capital to repay the $34 billion of bonds sold during a decade of rapid economic growth and historically low global borrowing costs. Turkish banks alone have to service $7.6 billion in U.S. denominated debt by the end of 2019. The material level of foreign currency borrowings among Turkish institutions make them vulnerable. And if the Turkish lira tumbled to 7.1, then the excess capital in the Turkish banking sector would be wiped out, according to some very serious work I went through. While the market has already punished Turkish banks, they are not the only culprits behind the nation's ravenous dollar-denominated debt binge, and there are no less than 16 billion reasons why the Turkish currency crisis, unless arrested early, would morph into a debt rollover crisis. According to Bloomberg's calculations, major Turkish companies, financial institutions, and the governments are facing a bond wall of at least 16 billion in bonds, denominated in foreign currency, that are due by the end of next year. The amount due by the end of next year is mostly composed of debt issued by Turkish financial institutions and includes conventional bonds and Islamic sukuk bonds valued at a minimum of 100 million at the time of the issuance. Investors will be closely watching if banks and corporations, not to mention the government, will be able to maintain access to the foreign funding they need, not only to keep economic activity humming as the country's currency plunges, but roll over maturity debt. The alternative would mean mass defaults for the companies that make up the core of Turkey's economy. So far, a currency crisis has not turned into this debt crisis, although that is largely due to the lack of imminent debt maturities. The longer the crisis plays out and the lower the lira drops, the greater the likelihood of a catastrophic outcome. The bigger wild card is how the country will be able to maintain the critical inflow of foreign capital to keep its current account funded. We highlight here Turkey's specific vulnerabilities on a relative basis. Turkey's external borrowing as a percentage of GDP is noteworthy. In particular, private sector external debt to GDP has grown at a very fast rate as a result of recent privatization tenders and large infrastructure projects which were run as public-private partnerships or PPPs. We see here that the level of corporate debt in Turkey and many emerging markets is extremely problematic. We have talked about this issue and the growing level of zombie corporations extensively lately. Global quantitative tightening, if allowed to continue, will bring an end to the current business cycle. This is for a multitude of reasons, but the most pressing of them is the fact that quantitative tightening will raise rates and suppress liquidity. It will raise the cost of indebted companies, drive zombie companies to insolvency, and ultimately crash the asset markets. A global debt crisis of epic proportions and a depression are likely to follow. Turkey may show what it just might look like overall. Most debt crises have been triggered by mistrust towards the finances and currency of the indebted governments. This time, the private companies are considerably more indebted than the government. Because of this, the coming debt crisis will be harder to defeat than the previous one. If the companies have borrowed massively from abroad, the falling external value of the currency will increase their interest payments and diminish their ability to service their debts, thus feeding the currency crisis. This is the heart of the crisis in Turkey. The common response to a debt and or currency crisis has been raising the interest rates and shoring up the government finances with, for example, structural reforms to increase the confidence of the international investors. More drastic measures have included capital controls, defaults, or calling the IMF for assistance. However, with a highly indebted private sector, the rate raises damage the ability of companies to service their debt and to roll them over, especially if they are unable to halt the fall of the currency. Although the order of President Erdogan not to raise rates may seem counterintuitive, the interest rate rises could just wreak more havoc by bringing more burden to the already damaged corporate sector. Bloomberg reports that Turkish banking regulator BDDK has approved new rules on loan restructuring. Banks can extend maturities, refinance, lend new loans, seek new collateral, and sell debtors' assets against receivables under the new regulation, which will allow lenders to temporarily, that's their word again, suspend, reflecting the negative impact of mark-to-market security losses on their capital adequacy ratio calculations. The Turkish current account is crippling. The chart reminds me of Greece prior to the EU banking crisis. Who is going to step in or continue to fund Turkey, especially as inflation pushes north of 15% and the central bank rates are at 17%? The rate of collapse of the Turkish lira is almost unprecedented in recent times, other than the Russian ruble in 2014. Obviously, as the lira plunges, their already disastrous current account will only get worse when it is reported going forward. We simply can't forget and must recognize that we have two very unorthodox leaders at the decision pinnacle of the Turkish crisis. And remember how I stressed earlier that it's confidence, it's in the system that will restore or stop the escalating contagion. And these leaders are not demonstrating anything that would really restore that confidence that I've seen so far. Rather than opting for interest rate hikes and an external funding anchor to support domestic policy adjustments, the Turkish government has adopted a mix of less direct and more partial measures, and this is at a time when Turkey is in the midst of an escalating tariff tit-for-tat with the U.S., as well as operating in a more fluid global economy. Rather than sticking with the approach taken by numerous other countries, including Argentina earlier this year, by raising interest rates and seeking some form of support from the IMF, Turkey is currently shunning both in a very public and populist manner, including through strident remarks by the president. What few truly appreciate is that even if Turkish institutions have the ability to pay, something many analysts frankly doubt, President Erdogan, many are rightly concerned, will forbid them from doing so. There is no doubt that the Turkish president has more than something of a Hugo Chavez about him. This is potentially a large default and could prove to be almost a total default. It appears Turkey is digging in its heels following the doubling of U.S. tariffs on steel and aluminum. It is quite clear the escalation of the lira's fall was brought on by political issues. Some believe President Trump's actions involving the release of a missionary provoked the collapse of the Turkish lira. It will be interesting to see here who blinks first. Turkey is a member of NATO, and yet it purchased a missile defense system from Russia, and at the same time it ordered several U.S.-made F-35 fighter jets. I'm certain this caused many security issues and certainly brought into question Turkey's solidarity with NATO. Furthermore, Turkey has been the gateway for massive refugees to enter EU. Turkey's failure to control its borders in the future has and will create security risks to much of the EU and the developed world. A combination of all these reasons provoked President Trump to double the tariffs on steel and aluminum. Turkey subsequently has retaliated with its own tariffs on automobiles and spirits. The Turkish president so far has resorted to 1. Removing mark-to-market accounting requirements for banks and corporations. 2. Asking citizens to patriotically exchange their U.S. dollars for Turkish lira. 3. Stopped importing iPhones and U.S. electronic products. And 4. Mobilized at least $15 billion from Qatar to be used for direct investment in Turkey. It appears to me the issue with Turkey can only be resolved through some method of negotiation with our State Department, which will involve a more long-term fix with the International Monetary Fund. What I started with in this discussion is the fact that the problem is the overall emerging markets, not just Turkey. The elephant in the room is the emerging markets, and specifically Asia. Debt in emerging markets has exploded, and this debt comes with some very unique problems. We believe as a result of this, as stated earlier, there's a strong 25% plus chance of Turkish default within 12 months. The Turkish president is not following the 3 standard responses to funding a crisis: an aggressive monetary and fiscal response, 2, seeking help from outside, and or creating a currency board closing convertibility of the Turkish lira. The present approach contains none of these elements, which could lead to further escalation and an overall emerging market crisis. We also believe there is a 40% chance that the global recession arrives by Q4 2018 or Q1 2019. This recession would spring from the enormous underestimation of the damage done to SMEs and MMEs by tariffs, a rising marginal cost of capital, and a U.S. dollar that is too strong for the world's indebted markets. Also, we believe there's an 80% chance of a strong reversal of quantitative tightening from the Federal Reserve, supported by the ECB and other major central banks. The timing could be signaled possibly as early as this month's Jackson Hole event. Overall, U.S. monetary policy and growth have peaked, and the mini crisis, together with the Trump administration's trade tariffs, is creating a need to first pause and then reverse policy lower. The world is almost coming to a standstill from the Fed's extremely hollow tightening. We will continue this discussion in part 2, where we will expand on the emerging markets further and how this will inevitably lead to another EU banking crisis. We warned of this in our 2014 series on the echo boom. We encourage you to revisit these macroanalytics videos, which can be found on our YouTube channel archives. So in closing, as I always do, I'd like to remind you, remember, the answer will be to print more money. It is the only answer politicians will ever agree on. That is, until no one wants or trusts the money. Invest accordingly. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed professional financial advisor. So until we talk again, may 2018 turn out to be an outstanding investment year for you and your family. And I thank you very much for listening.